Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, the other day I was on the Motley Fool website and they had an article, should you contribute to the TFSA or RRSP first? Great question. It's a question that comes up regularly for people. So if you're fortunate and you can do both, then you'll want to do both. But if it's a bit of an either or decision for you, then which should you do? Now, I think for many people, defaulting to just get that savings into your tax-free savings account would be the first default. Now, there's times when you should deviate from that decision. But of course, the TFSA is very powerful. When you put money into the account, any earnings on the investments, whether it's interest, dividends, or capital gains, will compound on a tax-free basis. And when you pull the money out, there's no taxation. Very powerful. So yes, you don't get a tax credit or a tax deduction when you push money into the TFSA, but to get tax-free compounding is amazing. There's very few opportunities in the tax code to do that. Another example would be real estate. So if you have a principal residence, it grows in value over the time and you sell it, there's no capital gains tax you have to worry about. Now, when do you deviate from that basic rule of thumb? You begin putting emphasis on RSP contributions when you see spikes in your income, or if you think that your income is going to be higher during your working years compared to your income when you retire. So I've got some information from taxtips.ca on the page here, and we'll just take a look at it together. So this is Ontario, both federal and Ontario tax brackets, and we'll look at ordinary or regular income. And you can see here that on the first $51,446, the marginal tax rate is 20%. And if I go from, let's say that $51,000, I go to, let's say, $90,000, that now marginal tax rate is 31%. So there's a jump of 11% in the marginal tax bracket. So with the RSP contribution, unlike the TFSA, you do get an immediate tax deduction. So if I can deduct at 33%, there's some value there. So keep this in mind. I can deduct at 33, and then when I retire, I'll pull the money out, let's say at 20% if I think my income is going to drop. So in a situation where you think your income is going to be higher, then it may in fact make sense to push the money into the RSP account, get the tax deduction, get tax-deferred compounding, so you don't have to pay tax on the earnings within the RSP account. That's all tax-deferred growth. And then when you get to retirement, you might be pulling the money out at a lower tax bracket. And this is essentially how pension plans work. We sometimes complain about the tax we pay on RSP accounts, but basically pension plans, RSP accounts, you put the money in, you get a tax deduction, all the earnings grow on a tax-deferred basis. You're not getting T-slips for that income. And then when you retire, you'll pay tax on the income coming from your pension plan or your RSP plan. The only difference here is that there's no one forcing you to make those contributions, which may be the case with your employer. So now you're a free agent. Do I put the money in the TFSA or the RSP account? All has to do with how you think your income is going to change over the years. So sometimes it's just a one-year spike. So again, you've got a spike in income. You don't make the TFSA contribution. You look at your TFSAs and go, I'm going to push enough money into my RSP account to bring myself back down to that next tax bracket. So if I'm 51 to 55 or 51 to 90, I'll push money into my RSP account to get that deduction at a meaningful rate. It would make sense to do that. So that really is a bit of a summary in terms of how to make these decisions. It's all about your tax bracket, and we've run the numbers many different ways. I mean, for anyone that is jumping a bracket or going down a bracket in retirement, the RSP still often will make sense for people. Now, the ideal scenario is you're fully leveraging on your RSP contribution opportunities and building up money in your tax-free savings account as a mad money account, a margin account to deal with unexpected expenses, or to be a supplement to your retirement income. Anyway, I hope that is helpful for you. If you're looking for additional resources in the area of retirement and finances, or links to some educational resources in the show notes. As well, you can find out how you can get a complimentary retirement forecast. Anyway, wishing you all the best in your wealth planning journey. You take care. Bye-bye.